Can you talk a little bit about the additional costs that may be hidden? Because I've seen where one of my agents that's in my office I manage came to me and he's like, hey, this guy is getting this incredible rate. He thinks he's doing this great thing. But then when he got his loan estimate, oh, lo and behold, there's $15,000 in charges.
Yeah.
Hey, everybody. Thanks for checking out another episode of the Aaron Advantage podcast. Today, I am joined by Tyler Weaver with Liberty Federal Credit Union. Tyler, how are you doing today, man?
I'm good, buddy. How are you doing?
I am doing pretty good. I'm actually really excited to have a lender in on the show again. It's been a while since I've had some conversations around financing, and I find that that is one of the topics that is the hottest in the market today. So I figured I'd get somebody who's knowledgeable about the pre-approval process and what it takes to get a loan to set some people's minds at ease, because the market's changed a little bit since the last time we spoke.
Just a tad.
Just a tad. So to kick it off and to really get the conversation started, I think the most important thing, which has always been this way, but I think is even more important to talk about right now, is just because the market has changed a tad doesn't mean that it's become easier for buyers. And the most important first step that I always tell every client that they need to take under their wing is getting pre-approved and understanding their affordability. So first and foremost, can you tell us why it's important to make sure that you have a pre-approval in place before you start the home searching process?
Yeah. So first and foremost, there's lots of parties involved in the transaction, namely yourself as the real estate agent. That's a big vote of confidence that that you're going out, you're taking your time, your efforts, your resources for that buyer, that you're going to actually be able to close a transaction at the end of the day. There's not a whole ton of cash buyers right now. So that's going to be a big part on any type of a third party. But on the lender side, it's going to allow us to go through all of the details of you and your snowflake individuality as far as a transaction is concerned. Make sure we don't have debt to income ratio problems. Make sure we don't have fluctuating income problems, which is tending to be a more and more challenging issue.
The gig economy is back and strong.
It is. And all of these things have to come into play. And if you're already locked into a contract, fully executed purchase contract has gone through and everybody's waiting for a closing in 30 days or less, and come to find out, oh, well, that 3 weeks you took off last year ruined your 2-year average, and now you have fluctuating wages, and it changes the way I have to calculate your income. It tends to create challenges that could have been fixed by just making a phone call up front.
Yeah, absolutely. And there's a lot of words get tossed around interchangeably on the front end when people are looking at figuring out what they can do with a mortgage, and then pre-qualified versus pre-approved. Can you explain the difference a little bit, and which is better or worse, pros or cons of each of those?
Yeah. Pre-qualification is going to be that initial first step that most people are going to encounter with just your loan officer. In some areas of the country, just due to the aggressive nature of the market, some listing agents prefer to have a pre-approval. The difference is the pre-qualification is a loan officer's review of your file, and they do an automated underwriting system, which is basically just a computer that says as long as you have these bits of information in the right spots and it's correct, then you should be approved based on this preliminary information.
Right.
A pre-approval actually goes to an underwriter after the loan officer has reviewed everything, and the underwriter will go through the file with a fine-tooth comb, just as they would as if an existing transaction was in place, and they'll do a conditional approval, barring title work, appraisal, flood certification, third-party services that you can't determine until you have a specific property in place for the transaction.
Right.
And that's it.
So it sounds like the pre-approval is a little bit more in-depth of the process to make sure that things, all the I's are dotted, all the T's are crossed.
Correct.
Based on what we can find
Nothing's
out before
being
we have
missed.
that.
Yes.
Absolutely. That makes perfect sense. Now, how does getting pre-approved help the homebuyer during the house hunting process, on the lending side as far as what they're looking at? And I'll kind of touch on how it's vastly important on the realtor side as well.
So on our side, in my experience, I typically find that people will have a tendency to overestimate what they can afford compared to what the government says a lender should allow you to afford. So that is probably the biggest, is just to make sure you're setting realistic expectations as far as an expected payment, along with what type of price range you should be looking for houses to have that expected payment. Just because you really like those $450,000, $550,000 homes, but you can't afford more than a $2,500 monthly payment. Well, we want to make sure that you're looking in the right places from the get-go and not wasting anybody's time because we didn't do a simple mortgage calculation.
Yeah, and before I get into how important it is for the realtor to have that pre-approval in place, you hit on one of the topics I wanted to talk about, which is affordability, and affordability versus just what the loan amount is. So I think that a lot of people, when they're thinking about what they can pay for a house, they ignore a lot of the other factors on the affordability side about being inside that home. Like, hey, what are my utility costs? What's it going to cost for me to eat? And what's my lifestyle cost going to look like? So, there's a rule of thumb that a lot of people look at as far as the DTI on how much they can get as far as a loan. What's your recommendation on people when they're thinking about, hey, should I max out my loan automatically, or what do you kind of coach people on thinking about in that vein?
That's an answer that's going to be a different answer for each person. Some people are just fine maxing out their DTI and having 50% or more of the income that they make in a month going 100% towards their house. And if you're that kind of individual, that's fine. We can accommodate. Most of the time, though, I like to have people below 40%. If you talk to a debt planner or a financial advisor, they're typically going to tell you don't want to spend more than 30% of your gross income on housing expenses. Unfortunately, that doesn't get you a whole lot of house for most individuals.
Right.
So a lot of people will stretch into that 40 to 45. 40 to 45 is a good, safe range that I would think that most of America is probably in that bracket as far as how much money is going towards my home compared to how much money is saved for expenses, vacations, trips to eat out on the weekends, things like that.
You said something really important that I think is it makes me really happy to hear how you said it. I don't get to decide what that number is for somebody. It's having the mindset of service to say, hey, here's the range of different things we can look at. You tell me what's most important to you. And that's how I've always kind of run my businesses. I want to make sure that I'm doing what's right by the customer. A lot of people get into this industry on the real estate side and the lending side and want to tell people what to do. And I think that's a lack of service that has perpetuated through both our professions, unfortunately. And I am very happy to hear that you take the same kind of approach where it's like, hey, here are your options. You tell me what works for you.
You have to. If you have options, why shouldn't you know the options? Right. That's plain and simple. That doesn't really need much more explanation than that.
Yeah. And to go back to why it's important to have that pre-approval to help a home buyer during the house hunting process on the real estate side, I think a lot of people have seen headlines and things to say, oh, inventory is expanding, days on market are growing. That means that it's super easy for buyers to be able to negotiate these
buyer's
great deals.
market is right around the corner, and that's not the case.
Definitely not the case. I just saw statistics for the state of Indiana. We have a 1.7 month supply of inventory, which is this theoretical number that doesn't mean anything to a lot of people. But what it means is that if no other homes came on the market today, every single home in the state of Indiana would be sold in 1.7 months.
Yep.
A balanced market is 6 months supply of inventory.
Yep.
So it is still a seller's market. And I can tell you right now that if you're thinking of buying a home and you don't have that pre-approval in place and you go and you find one you love and you think, oh, I've got all the time in the world, just because the average days on market has grown doesn't mean the median days on market has expanded. And if you're in a competitive price range, you need to be ready to pull the trigger immediately. And the only way you can confidently do that and have a seller who's willing to accept that offer is to make sure you've got the backing of a pre-approval in place at that point in time.
And you've had the conversations up front about how far do you want to extend yourself in that situation?
Right.
Because it could be a dream home. And if that's the situation, if it's your forever home, well, then you might be a little more willing to extend yourself than if, say, it was your 5-year home.
Absolutely. Now we're going to get into the important topic that is on everybody's minds right now. And this is the thing that's changed the most since the last time we spoke. Interest rates.
Yeah.
They've changed a little bit. They're no longer in the 3s and 4s. You're seeing them a little bit more in the 7.5 range. How important is it for a consumer who's thinking about purchasing to make sure they're looking around to find the best rate product and the best institution for them?
As a citizen in a capitalist society, this is one of the best things you've got going for you, especially in a market like we are. If you have the option to shop for rates and lenders and all this good stuff, you should absolutely be taking advantage of that. Even as a mortgage loan officer, it's probably not in my best interest to tell my clients to shop around, but I still catch myself doing it. If I was going to, I would shop my own lender that I work for.
Right.
Why would I not want to save money on an interest rate? Now, how could I expect anybody else to not do the same exact thing? It's important. You could have the difference between sometimes an interest rate percentage, sometimes 1.5% from lender to lender, depending on which type of product you're going for, whether you're doing some specialized portfolio product or a normal sellable transaction. And without getting too deep into all the mortgage world, that's just a standard transaction compared to something that a lender might want to bend the rules a little bit because they don't have a need to sell it to Fannie or Freddie or something like that.
Right. Yeah. And you know, you kind of already hit the head on one of the questions is you can have a massive variation in what the rate looks like at the different lending institution. You could have a different rate variation with the same institution if you're not going into someone like you who's asking the questions to find out what is the best product for you. Because there are some people that think, hey, I absolutely can't have PMI. I have to put 20% down. It may be a cheaper option to look at FHA with a smaller down payment. You're going to have that PMI, but in the future, if rates change or the values change, you can always refinance or change things in the future. And the short-term rate may not always be the best option for somebody.
I agree. There's always options out there, depending, once again, a lot of the things we talk about are extremely circumstantial from person to person. But yeah, there are going from conventional to FHA. If you're in the right area, you could look at a USDA. If you're a veteran, they could go with the VA loan, which has no down payment requirements and no PMI. I mean, that's a pretty good scenario. But we still have veterans that will go ahead and put 20% down and go conventional financing.
Right.
There are little nuances to each transaction that might help decide that answer for you, depending on the home and the market and all this kind of stuff. But yeah, you should be presented with all of these options because the difference of a percent less on an interest rate and a small, we'll say $75 monthly PMI could still be $100 or more less than the higher rate you might get with conventional, just because that's where the markets are priced in the secondary side of things.
Right. And I think you hit something on the head that I think goes under the radar for most people is there's little nuances on every single transaction. You know, I always make the joke that people say, hey, Aaron, what's a standard transaction look like? And I said, I have no idea. I've only been doing this 17 years. I haven't seen a standard one yet. So getting in front of somebody who understands those nuances and having the conversation, especially on the front end before you're out making the offers.
That's the time to have those conversations.
100%. You can find out so much by having, a 30 to 60 minute conversation with a lender. You may not even be ready to buy today, but just to understand what the options are, and it may be eye-opening to get you to the point where it makes the most sense.
Absolutely.
Now, we've talked about interest rates and things, but there's also going to be additional factors that borrowers should consider when they're looking at picking the right product for them. Can you talk a little bit about the additional costs that may be hidden? Because I've seen where one of my agents that's in my office I manage came to me and he's like, hey, this guy is getting this incredible rate. He thinks he's doing this great thing. But then when he got his loan estimate, lo and behold, there's $15,000 in charges.
Yeah. So that is something. So advertised rates, you've got to be careful with those.
Right.
There's usually a little asterisk there somewhere in very small print somewhere at the bottom. This is based on, say, 20% down or 40% down with a loan amount not exceeding $450,000 with 760 credit scores and all these little factors that go into why that rate is available for that specific scenario. If you are not in that scenario and your loan officer should be helping you to find that out, then you don't get that rate.
Right.
Same goes if you do and you find a lender that is offering those rates, and those are the only caveats to that rate, and they try to tell you you should be getting something different. Well, that's an advertised price right there.
Yep.
So that needs to be offered to the individual.
Yeah, and some additional things. Let's talk about origination costs. Let's talk about admin fees. All these things that people don't even take into consideration.
Yeah, these are going to be things that you're going to find that differ more from the type of lender, not lender to lender, but the type of lender. Once again, I don't want to get too deep, but there's traditionally 3 or 4 different kinds. There's your retail lender, which is like your banks and credit unions. There's your mortgage correspondent lender, which is like a mortgage company where they will actually fund the loan yourself, but they will quickly turn around and sell it to another servicer. And then there's a mortgage broker, which is just a true middleman in a transaction. He's connecting a client with a lender and providing the service of the transaction. These differences are going to dictate what type of possible hidden fees you might see. With a credit union or a bank, there likely will not be any hidden fees in the event that all of the information was brought out front, meaning they could have correctly gone through debt to income ratios, all the little areas that change the rates and what each rate costs, et cetera, et cetera. Whereas a mortgage company themselves, they can charge points and fees like any other lender can to buy rates down. That's not something that differs from lender to lender. But one thing they will have typically is either an underwriting fee or an origination charge. And this is kind of how they supplement the loan officer themselves and the work they do, considering they're going to sell the loan off. Whereas a broker specifically, they aren't selling the transaction, they are just providing the service. So all of the fees and money that's supposed to be made on a transaction through a mortgage has to be made for that individual broker on the front end of the transaction, i.e. closing costs.
Right.
So you'll have the most upfront fees, like most of the time, not always, on a broker side, kind of a middle ground on the mortgage company, the correspondent lender side. And then the banks, they will typically have lower fees, all these kinds of things, but they tend to not be as aggressive in the competition when it comes to rates.
Makes sense. That makes total sense. So that actually hit one of the things that I was going to talk about. There's pros and cons for all of these different institutions. And again, going back to what you said earlier, shopping around to find what product fits you best is the best way to get that done. And having someone who's willing to educate the consumer on what options they have available, I think is vastly important in the process.
Yeah. And as a little self-plug, I don't like to do self-plugs, but I am a loan officer for a credit union.
Right.
So there are ways to get the best of the both world. You can use the bank or the credit union because maybe you like the loan officer, you've got your accounts there, et cetera, et cetera. Sometimes these banks, credit unions will have some type of a matching rate program. We have the rate match program. That way you can still achieve those more aggressive rates that you might find from another lender with the same type of service that you would find with a larger institution, bank, credit union. But that's only going to come from shopping, right? So full circle, guys.
I couldn't agree with that more. Let's get into another thing that's impacted everybody in every industry in the world, and that's how technology has impacted the loan origination process, especially with the difference between like a online portal that people could utilize and maybe go into a local lender. And I'm not here to disparage anybody or say anything bad. I've heard a lot of people just talk about how terrible it is to have, and I won't use their specific name, but this one particular online broker, all they're great at is advertising. And I'm like, it's a product that works for a lot of people. And my thing is, what are the pros and cons of saying, hey, pro of using both an online portal and a local lender, and cons of utilizing both of those potentially?
Yeah. Pros, I'm going to say, if you are what we like to call in the industry a vanilla client, meaning there's no hair on theirs, there's no bankruptcies, there's no divorces,
no late payments,
low credit scores, fluctuating them, all the things that propose a challenge in a transaction. If you don't have any of these type of features and you're going to standard 20% or more down, going for a 30 or a 15-year term, those I would say easy to do files.
Yep.
You're probably not going to see much of a difference between going with one of those large online lenders and a credit union or a bank or correspondent lender, something like that. So the pros could just be ease of access. And I would say that probably is mostly logistic ease of access. Right. You can just get on your computer at any time and do anything you want to with your mortgage. Now, a pro or a con to that is going to be just access to an individual. Right. You might have to go through 2 or 3 call prompts to get a hold of your actual loan officer if you ever even speak to them. Right. So in a lot of people's minds, I think that's pretty important. And I feel like it's getting pretty important nowadays with so much misinformation and disinformation out there. But maybe you don't care to talk to your loan officer and you just want the house and you want a quick, fast mortgage. And if that's what you've got, then that's what you're going to get.
And if that's the case, and I'll just put this out there as well, that's no different than them working with you as a local guy. Do you ever have physically require someone to come in and sit down with you and say they have to be here and do these things?
Absolutely not. No. Naturally, with modern technology, most lenders are going to have that online portal. Right. They're going to have everything that the big online lenders are going to have. And frankly, a lot of times their costs are going to be a little more focused towards the local market. Right. And what I mean by that is just because they're paying $900 for an appraisal in California doesn't mean we're paying $900 for an appraisal in Indiana. But that big online lender is going to have a standard appraisal fee that they have for everybody. So you might potentially be paying more in costs, not necessarily lender fees, but just average cost than you wouldn't necessarily have to if you went with somebody who was specialized in your local market.
Yeah, that makes a lot of sense. The largest home buying generation, and it drives me crazy because I've been in the industry for a long time and I've heard them talking about the millennials are coming, and I'm just like, I hear all these stats that millennials are going to buy their first homes and do all this stuff in the next 10 years. And I'm like, I'm a millennial. I'm owning my 3rd home currently right now. And we've talked about making another purchase. So it's like, we talk about the millennial generation as there's some foreign entity. And it's just like,
I wouldn't count them out. They're going to come back strong. They're supposed to be the highest inherited wealth in history. So just because they're holding back a few years doesn't mean they're not going to come out of the gate real strong when they do.
Absolutely. Couldn't agree more. Now, what I will say with that is they're also the first real generation that has the access to the technology and things that they've utilized their entire life. One of the things that I think is most important, especially with first-time home buyers, is making sure they understand the complexity of what it takes to get a mortgage loan and why it may be a benefit to talk to someone local to get their options and understand it before they get into that. Because when I got my first home mortgage, it was – I'm trying to remember what year it was, but it was kind of before the Dodd-Frank implementation of all the changes. So it was pretty simple process overall. When I got my second mortgage, process had changed substantially. So can you talk a little bit about what that process looks like and why it may be more beneficial to have the ability to have those in-person conversations, and why a first-time home buyer may consider, even though they've got this great use of technology, that they may want to try to go somewhere local first?
That's kind of a 2-part answer. I would say that a lot of millennials, as much as they are searching for their information online and other resources, they are still paying attention to relatives and family and friends and what they say. One of the antiquated bits of information that I hear is, I've got $100,000 in the bank. I only want a $150,000 mortgage. What's the problem with this? That's all asset-based lending. Most lenders don't do that anymore. Right. As you know, or since the housing market crash in 2008, Dodd-Frank, RESPA, TILA, ZILA, all of these other regulations that are out there.
LLPAs and all the acronyms. Yes. I call it the alphabet soup of acronyms.
Yes. All of these things that have slowly piled on for what we have to do to stay in compliance and make sure that everybody's aware that they can afford the home, all these things. It's just kind of you want to have these conversations because it's not going to be just a couple phone calls and let me sign this piece of paper and then a week later we close like it was with pre-housing market crisis. Right. Since then, there has been so many, I hate to say it like this, but so many lawsuits that every year there's a few extra pieces of paper that we have to sign.
I always joke we kill a small forest for every closing.
And now you're going to sign somewhere between 120 and probably about 175 different pages at closing. And all of those are things that we've done on the back end. So these conversations allow you to have realistic expectations on timelines,
right?
Realistic expectations on the need to liquefy your assets if for some reason you need to. These are all conversations that if you don't have up front and you're not prepared, you might be caught behind the ball and everybody's sitting there waiting to close and you're the one holding them up.
You know, I think that's one of the things that is of paramount importance is I tell people all the time, no matter if I'm working with a seller or with a buyer, I want to sit down on the front end so that I can set out the expectations of what's going to happen throughout the process, because stress arises when there's unmet expectations. And the truth of the matter is I may not have a clue what your expectations are if we're not having that conversation up front. There's a lot of people that think, oh, we just signed a couple documents, we can close on the house in about 2 weeks.
Yeah.
What's the average turn time on most of the financing that you're operating with on buyers these days?
Yeah, my average turn time, I think as a company as a whole, we're about 21 days. Mine is about 14 days.
Killing it.
And this is the 21 days is also due to our turnkey transaction and construction loans that take a year. So obviously those numbers, the 21, it could be a little bit different. But you know, you're going to get into a situation where a good loan officer is going to say, hey, this is what we will likely be looking at. But as an expectation, let's plan on 30 days or 45 days. If for some reason there's some repairs that need to be done, and we know they need to be done, let's plan for 45. Let's write a 60-day contract up front. And if we can close early, great. Everybody's going to be happy about that. But there's no reason to set unrealistic expectations because you're just going to let people down.
Couldn't agree with you more. I think that hits all the questions that I really wanted to talk about today, because I think it's most important to educate consumers on what their options are on the front end. Is there anything specifically that you could think of that's an important thing to remember that maybe we haven't touched on today?
The biggest thing, and we have inadvertently touched on it by our entire conversation, is and I cannot stress this enough. And if you go as a lender, if I go to 100 different real estate agents and I say, what is your biggest complaint that you see from loan officers and banks? Aaron, what is your biggest complaint that you see?
Lack of communication.
Communication. Every step of the transaction, from that very first phone call, recognizing that if you have a first-time buyer, you should probably explain what the word escrows mean.
Absolutely.
You know, and if I ask for a fully executed contract, you should explain what it means. You should let them know that there are no dumb questions. If you're talking to a third and fourth home buyer, a move-up buyer, you should say, hey, I understand you've bought a few homes and you probably know what escrow means and all these other verbs and acronyms that we have now, but it's probably been a while, so we're going to cover those things again. On top of that, somebody who's going to say, hey, let me get a hold of your agent. Let me introduce myself. We're going to call the title company. We're going to call the listing agent as well. We want to make sure that all parties in this transaction have open lines of communication with you, with the lender, with the real estate agent on the buyer's side, with the real estate agent on the seller's side. I can't talk to appraisers, but the listing agents can, that kind of stuff. So I cannot stress how important it is to communicate. So if you're looking for lenders or even just anybody who's going to help you to be on your team in the real estate industry, that guy that took 4 days to call you back, just wait till you get in the middle of a transaction. But that guy that's calling you back within an hour or two, you're gonna have a smoother transaction just in the simple fact of knowing what's happening.
You took the word right out of my mouth. I always say that I am on a team with your lender throughout the transaction to make sure that we make this process as smooth and stress-free as possible. Because guess what? Buying a home is one of the most stressful things you're going to do in your life. And I don't want to downplay it, make everybody think, oh, it's cupcakes and rainbows and it's so easy and everybody's excited. There's a lot of work that goes into it, but making sure you have the right team makes it as enjoyable as possible. And I can tell you right now, I've done several deals with this man right here, and the communication is always on point, and he makes sure that everyone knows what's going on. And that is one of the things that I absolutely love on either side of the transaction. I can be the listing agent, I can be the buyer's agent. I always know what's going on, and that is very, very much appreciated.
Yeah, well, if it was your purchase transaction, wouldn't you want to know what's going on?
Absolutely.
Yeah.
Yeah. So
I feel like that's not a difficult thing to accommodate.
it's not a difficult thing to accommodate, but it's a difficult thing in practice, unfortunately. It's one of those things that I do a lot of traveling and speaking, and it's funny whenever we're talking about technology and doing all these things. I have this little anecdote that I always use. I say, all right, everybody, pull out your phone. I'm going to tell you right now the app that I use most often that has made my business the smoothest it's ever been and has made me more money than any other app I've ever used. And I say, it doesn't matter if you're on Android. It doesn't matter if you're on iPhone. Everybody's got this one. It is this little guy right here. I don't know if you can see it, but it's the one that looks like a phone. Pick it up and talk to people, and you'll be amazed at how much easier your life gets.
Yeah.
So, Tyler, appreciate you coming in today. Always look forward to these conversations. You make the difficult process of understanding the lending side so easy and so smooth, and I couldn't thank you enough.
Thanks, buddy. I appreciate you having me out.
My pleasure.